Good morning. It's Jeffrey Christian of CPM Group. It's about 10:45 here in New York on Friday, the 9th of May. I will talk at the end about our market outlook for gold, silver, platinum, palladium. But today I'm going to take a slightly different approach. I'm going to talk about the Federal Reserve, why it exists, and what the history of the creation of the Fed, and what the Fed can do in future financial crises. I will be doing this as a video, and I will be streamlining the information. I know a lot of times people will say, well, gee, Jeff, you kind of cut corners and you left this out and that out in your videos. That's true. I mean, if you want me to do a 16-week course on monetary policy, I can, but for a 10 or 20-minute video, I'm going to have to streamline the information. So please understand that. I've also added a border here. On May 30th, we will celebrate the 39th anniversary of leaving Goldman Sachs and starting CPM Group as a independent, conflict-free research and consulting company focusing on commodities and precious metals markets. We had worked at J. Aron and Goldman Sachs prior to May 30th, 1986. But on that day, they struck a agreement in principle with me to allow me to take the commodities research group out of Goldman Sachs and set up CPM Group and be their outsourced commodities research operation for an initial 3-year agreement. Personally, I am celebrating my 50th anniversary of writing about commodities. The first time I wrote anything about commodities, it was about oil, and it was in 1975. But by 1986, I was leaving Goldman Sachs to set up CPM Group. We've been around for 39 years this month. I don't think there are any other commodities research companies. Well, there are a few small ones that may have been around that long. But for the most part, we have a certain agedness to us. Now, I want to talk about the Fed. There are 3 areas I want to talk about. The Fed's charter, what the Fed is directed to do, and how the Fed and other central banks get derailed by the need to underwrite fiscal deficits and debt. And you have to understand the relationship between central banks in general and the Fed specifically, and governments. The Fed and other central banks strive to be independent, but what happens is that they have the responsibility to underwrite fiscal deficits and debt, and that can get in the way of them undertaking that which they're chartered to do. Why the Fed exists, I'll talk about that, a little bit about the monetary history of the United States. I'll try not to be too boring. What the Fed can do to support the U.S. economy in the next financial crisis, because people are looking at future financial crises, and they're coming. And the question will be, what can the Fed do? And then I'll talk about the precious metals markets a little bit at the end. The origin of doing this was a couple comments from D. Ward to a recent video that we did, in which I was talking about the Fed being chartered to try to maximize employment and keep inflation under control. Those are the 2 charters that the Fed has when and was given in 1913 when it was created by legislation at the end of 1913, and then it was organized in 1914. And I'll talk about why you do that. Can you help me understand the Fed group of bankers? Why do they really care about employment rates? Well, because employment was a good measure of the state of the economy. And back in 1913, the government actually cared about workers as opposed to corporations. Quite frankly, it's like, okay, that's where we are. Sign of health, yes. He says, shouldn't this be managed by the actual government? Yes, it should. Yeah. Does it? Well, the government does more or less. It is a matter of fiscal policy as well as monetary policy. And then at the end of the day, it's also a matter of real economic activity. corporations and workers have the capacity to take matters into their own hand and take control of their own destinies to some extent. Governments are there to assist people, at least the United States. In fascist Italy, the charter was that the government was there to assist corporations, which is very important to understand when you hear people talking about fascism. Fascism was state corporatism. But governments and monetary authorities, central banks, the Fed, are there ostensibly to help people and corporations, right? Not to control them, but to assist them, to provide a stable economic environment, to help direct them toward the suitable social policies and operations. He then added another thing, which is, hey, I'm not going to read a book. I'm a YouTuber. I understand that. But I have to say, if you're going to try to get to the truth, relying on what you see on YouTube and other social media is very treacherous, excluding our videos, and some others. I mean, there's a lot of good information, but discriminating the good from the bad is very difficult. It's very difficult in books. I mean, there's a great book about the Fed where somebody has gone very thoroughly through the monetary history of the United States leading up to the Fed and then after the Fed's been created. But he has a conspiratorial mind and twist. So he has this incredible amount of accurate information. And then at the end of each chapter, he sort of twists reality to conform to his conspiracy theories. So you really have to be careful, even with books that you read. Mein Kampf's a good example, I guess. If you really want to know, there's a book, The Monetary History of the United States. I explained that I did respect Milton Friedman. It was produced by Anna Schwartz and Milton Friedman. It's very interesting because one of the footnotes it has extensive footnotes. In some pages, there are more footnotes than me, but in page 192, 193, it talks about the fact that most of the gold that was turned in 1933 was turned in before the actual government decree saying turn in the gold. It also talks about the fact that Americans, each individual was allowed to hold up to 2 gold coins from each annual mintage from the 1870s to 1933, 32, so that you could actually hold quite a bit of gold personally in gold coins, and how most of the gold that was not turned in was assumed to have been lost or exported. Actually, it was kept by people, but there was no enforcement there. Very good book, but it's very difficult to read. It's very academic. Anna Schwartz was a great person. When we were at J. Aron in 1981, the Reagan administration convened a gold council, a special presidential committee to look into the role of gold in future monetary systems. And the chairman of J. Aron, Herbert Coyne, who was one of the smartest people I've ever been fortunate enough to work with, Herbert was part of that committee. Anna Schwartz was the official economist that worked on the staff of that committee, and Herbert seconded our research department to work with Anna. And it was a wonderful event to be able to work with her. She was a great person. And she also, I believe, went on to be on the committee that looked into the gold trains that were after World War II, not the Nazi gold train that a lot of people get distracted by, but after World War II, there were certain trains in which the Allies took Nazi booty, put it on trains, and moved it all to Austria to disperse it and see if they could find the original owners and things like that. There was a lot of gold on it, so they were called the gold trains, but there was also art and antique furnitures and other valuable belongings that the Allies collected from Nazi stashes and tried to find repatriation to. So Anna was a great person, as was Milton, and it was a real honor to work with her back then. Now, a short history of the monetary policies of the United States. I won't, go through this book, but the purpose of the Fed is to maximize employment and keep inflation under control, to help the economy stabilize. The origin of the Fed is that we didn't have a central bank for most of that time prior to the creation of the Fed. We had a first central bank of the United States and the second bank of the United States. Each one lasted about 20 years. And in between, we didn't have a nationally chartered bank. We didn't have a national banking system. Banks were overseen, in quotation marks, by states. The states, generally speaking, didn't have auditors or others. Currencies were issued by private banks. And those private banks were supposed to only issue currencies that were covered by gold or silver or other banknotes that they had in their vaults, in their depository. Realizing that the states were not really auditing them, there were a lot of banks, private banks, that would issue notes that they didn't have species, gold or silver or other banknotes, to cover. And there was a tremendous amount of fraud. You had private banknotes from all over the country. And if you tried to travel, if you were a pilgrim and you wanted to move from, say, Ohio to Kansas, you could take these banknotes issued by the First Bank of Canton, Ohio, or the First Bank of Toledo, Ohio, with you, and you'd get into Kansas and somebody would say, well, how do I know that this is real? So oftentimes what you would do is you would convert your banknotes into gold and silver coins and take them with you. Kind of treacherous, open to bandits and thievery, but much more efficient than other things. Now, in the creation of the United States, Alexander Hamilton pushed for and got the first Bank of the United States created in 1791. There was a lot of debt that the states, formerly the colonies, owed the federal government in repayment of money that the federal government had lent in colonials or currencies, continentals, they were called, during the Revolution. And the U.S. federal government and the Treasury under Alexander Hamilton wanted to build up gold and silver reserves in the federal treasury. So they required in the Constitution that the states were only allowed to pay debt in gold and silver. That's in the Constitution. It doesn't say that only gold and silver are currencies. It says the states may only pay their debt in gold and silver. And that was a way of the federal government trying to build up federal United States gold and silver reserves. And that happened during the first Bank of the United States, which was chartered for 20 years. In 1811, its charter expired, and we went into a period of about 5 years where we didn't have a national bank. Bank fraud exploded during those 5 years. Bank runs exploded. All of a sudden, people would say, wait a second, I have these banknotes, and I don't think that bank has gold and silver in it. I'm going to go down to the bank and get gold and silver and turn in these notes. And that was a bank run. And you had 5 years of that, so that the government in 1816 created the second bank in the United States. Well, now, the bankers didn't like that. All of a sudden, they were being regulated again. They couldn't just print banknotes willy-nilly and undertake fraud and counterfeiting. So when Andy Jackson was running for president, the bankers financed his campaign based on the idea that he would kill the second bank of the United States and the idea of having nationally chartered banks. And the second bank of the United States was allowed to die in 1836. Then you had the Civil War. Over the course of the next 80 years, you had all sorts of bank fraud and subsequent bank runs. And you had a boom and a bust in the economy. I've showed you in past videos U.S. GDP in the period. You had depressions, not recessions, depressions in the 1870s, 1880s, and 1890s. They were all precipitated by several factors, one of which was a shortage of gold and silver to meet the growth of the U.S. economy, which was very strong at that time. But another factor was the counterfeiting and fraud in banks, which led to repeated bank runs, which would then either collapse the economy, or threaten the economy. And this went on 1870s, 1880s, 1890s. In 1907, there was another episode of fraudulent banking, banks printing more notes than they actually had deposits to support. And that led to an almost cataclysmic global depression. J.P. Morgan, the man, and to some lesser extent his bank, actually supported the economy. The Treasury, the U.S. Treasury at the time, for a long while, was almost oblivious to the financial crisis that was racking the United States, threatening to throw us into another depression, and also wreaking havoc on the international trade. And the banks bailed out the federal government. J.P. Morgan put in like $25 or $50 million of his own money into the banking system to shore it up. He ultimately locked a bunch of bankers in his library and said, "You guys don't get out of here until we clean this mess up." And they stayed overnight, and they worked out an agreement to stabilize the banking system. At the end of the day, the Congress investigated whether or not J.P. Morgan had precipitated the bank run of 1907, when in fact he hadn't. He supported the economy when the U.S. government was totally not present. In the 90 months between 1907 and 1913, the U.S. economy was in a recession in 60 months of it. 60 months of recession out of 90. It's just it wasn't just one big recession. It was bank crisis after bank crisis. The government kept saying, we really should have a national bank, central banking system. But the Congress people were supported by the bankers who said, no, we don't want that. We don't want the U.S. government controlling the amount of banknotes that we can issue. So late at night, toward the end of the year, a bill was passed through Congress when a lot of those guys had already gone home for Christmas break and couldn't vote against it, to create the Federal Reserve banking system. It wasn't a conspiracy. It was the fact that the Congress people were all controlled by private bankers who were used to being able to undertake fraud, which caused bank run after bank run, which reduced the growth potential in the United States because of the risks involved in being involved with these banks. And the only way to get the Fed created was to go around those Congress people who were in the pockets of bankers. Sorry for all those people who think that it was the other way around. You can believe whatever you want if it helped you to sleep, but this is actually what happened. And that led to the creation of the Fed. Now, there's a book called The Nation of Counterfeiters. Great book. It's a history of monetary policy in the 19th century and all of those banks. The counterfeiters that the title refers to are the people who ran those private banks and printed banknotes without the deposits behind it. The Panic of 1907 is a great book that came out, I believe, in 2007, just as we were going into the great global financial crisis and Great Recession, talking about the bank panic of 1907, how it was created, how JP Morgan saved the U.S. economy and how the U.S. government was totally oblivious of what was going on for a big part of it. I put a third book up here, The Panic of 1893. I have a book called The Panic of 1893. I don't think it's this book. I don't think I've read this book, but there are several books that you can find on the bank panic of 1893, and the depression that occurred, not a recession, a depression that occurred as a result of that. So that's why we have a Fed. Self-serving banks. This is a rhetorical question. You don't have to respond to me. If you're surprised that bankers are self-serving, I'm not sure where you grew up. On the left-hand side, we have Jesus expelling the money changers from the temple. And on the right side, we have Mr. Potter from It's a Wonderful Life, the self-serving banker who would have impoverished everybody in there. If you are surprised that bankers or anybody else, you could even be an auto manufacturer or a purveyor of goods and services on the internet. If you're surprised that somebody is acting in his own best interest, I'm not sure where you grew up. All right, so next question. What can the Fed do in future financial crises? And I'll be honest with you, when I said I wanted to talk about the Fed, why it exists and why it cares about employment, there were people at CPM Group who said, no, our viewers don't care about that stuff. Talk about gold and silver. But there were other people who said, no, I think it's very important. And there actually was a comment in there, that whole thing, if you don't understand economics and you think that politics don't matter, you're not going to understand the gold and silver markets. If you want to understand the gold and silver markets, you have to study economics and politics. And it's very funny because in the 80s, there was somebody who asked about our track record calling the markets. And they said, Jeff Christian's not really good at calling the gold market. He's just really good at predicting global economic trends and stock market trends, which was a backhanded compliment. I actually have a pretty good track record in gold too, as many of you know, but that's beside the point. You've got to pay attention to politics, and you've got to pay attention to politics in a very careful way. You can't listen to politicians. You have to study the politicians. So what can the Fed do? So my colleague said, let's talk about the Fed and what can it do in future financial crises. All of a sudden, that has become a hotter topic again for some strange reason over the last 4 months or so. Probably a lot more than one financial crisis will occur. I don't think that we are approaching the end of days the way some of the gold promoters on the YouTube say. I think there will be future recessions and future financial crises, more than one, because I don't think the U.S. is going to collapse and go away. And that's very important when it comes to understanding what the Fed will do and what the U.S. government might do. Now, as I said earlier, central banks and the Fed have mandates basically to try to create a stable monetary environment for their national economies. That's basically their mandate. And it gets pushed aside because the governments run deficits and build up debt, and the central banks have to underwrite that debt. Now, an underwriter says, I will take your debt and sell it. Or if I can't find a buyer, I will buy it myself. I'll show you a chart in a second. So what happens if the markets stop buying Treasury securities? We are going toward a $2 trillion deficit this year. Debt is over $36 trillion. There's no real effort to reduce deficits and debt on the part of the U.S. government. They're exploding. $145 billion extra expenditures in the first 80 days of the current administration compared to the same amount of spending in a year ago, the same 80 days a year ago. So what happens if the markets simply say, Treasury, U.S. government, you just have been too profligate for too long. I don't want to buy treasuries. Now, I'll jump ahead. You have to look at the scenario more broadly. But in that kind of scenario, the Fed would buy the treasuries. That's what it did in 2008. That's what it did in 2020. I'll show you a chart in a second. Actually, I'll show it to you now. These are the assets of the Federal Reserve System. And you can see less than $1 trillion. The data only goes back to 2002 on this chart, into 2008, and then it more than doubles because the government needed money in the global financial crisis and the Great Recession. It more than doubles. And there were people who were saying, oh my God, the Fed is out of bullets. Think, no, the Fed's not out of bullets because the Fed's a bank. And if its assets have gone from 1 trillion to 2 trillion, its ability to buy more assets has doubled. And you could see that over the ensuing years up until 2014, it in fact more than doubled again, up to about $5 trillion. It started to try to pay down some of that and reduce some of that in 2018, 2019. But then when 20 came along and the COVID lockdown came along, it went from about $4 trillion, a little over $4 trillion, to more than $7 trillion. And then in the aftermath, up to $9 trillion. It has been reducing its assets since 2022, and it's gotten down to about $6.7 trillion. The reason the Fed has been reducing its balance sheet and continues to reduce its balance sheet is to prepare it for the need to finance the government in the next financial crisis. Right? That's really what's been going on. So let's go back to those bullet points. So the Fed, in the case that markets say, we're just not going to finance the Treasury, the Fed would buy treasuries as it has in the past. How much can the Fed buy? Actually, in theory, to infinity, because as it buys assets, its asset base grows, and that allows it to buy more assets. Banking 101. Sorry if you didn't do that. In reality, global markets can balk and say, no, that's not going to happen. We just don't want any more of this. They have not, despite what you'll hear people say on the internet and in the U.S. government. But in order to understand why they haven't balked and to understand the impediments to global markets balking, you have to take this scenario and look at it in a more broad context. If central banks, if investors of the world united and said, we don't want to invest in treasuries anymore, where are they going to put their money? Are they going to invest in the sovereign debt of other governments that don't have the creditworthiness and the economic strength that the U.S. has? Are they going to invest in private corporation debt or mortgages? Are they going to hold the money in cash in U.S. dollars because U.S. dollars represent like 80% of the private money held in the world and 60% of the central bank money? What's the market's appetite for other debt? As a Polish central banker told me during debt renegotiation talks in 1981, if you owe a bank enough, you own it. And the U.S. government's policy since the 1980s has been, if we owe the world enough, we own it. And to some extent, that's true. At some point, it can break. But for it to break, global investors, governments, as well as private individuals, have to say, instead of buying treasuries, I'm going to buy ECB euro denominated notes because Europe looks so strong compared to the United States. So in order to understand that whole interplay between the Treasury, selling Treasury securities to finance deficit spending, and the Fed either buying them, Fed owns, I think, about a third, maybe a quarter of Treasury debt that's outstanding. Either the Fed or others buy that. And for the others to rebel, they has to be willing to put enormous amounts of money in other assets, which of course would be hyperinflationary for any economy or government that is producing those assets. The Fed, we've always said, can try to stop the bleeding in a financial crisis, as it has in the past. It cannot heal government deficit spending and debt wounds. That takes the government. It's very interesting because Jerome Powell, in his press conference on Wednesday of this week, was asked, are you talking to the government about its profligacy in its deficit spending? And he said, I don't think that's the central bank's job. But if you look at it, Paul Volcker and Alan Greenspan repeatedly in their Humphrey Hawkins testimonies to Congress twice a year would go over there and say, the Fed controls monetary policy. We are chartered to try to maximize employment while keeping inflation under control. You need to deal with your deficits and your growing debt. That's a government function for the administration and the Congress, and you got to get it under control. And throughout the 80s and 90s into 2007 or so, Volcker and Greenspan repeatedly delivered that message both to the Congress through the Humphrey Hawkins talks, through special reports, and through lunches with the president. The president has yet to call Mr. Powell over for a lunch. Typically, new presidents have lunch with the Federal Reserve Board chairman within the first couple weeks of an administration. This guy doesn't do that. So the Fed can try to stop the bleeding in a financial crisis. It can sop up treasuries if people don't want them, because it is the bank for the U.S. Treasury, and to some extent underwrites that. But it cannot fix government deficit spending and debt. So that's what the Fed can do. Again, here's the Federal Reserve Board system's assets, down to $6.7 trillion, gearing up for the next crisis. And this is what Fed holdings are overseas. Federal debt held overseas through the first quarter, it's about $8.7 trillion out of that $37 trillion. And some portion of this is held by U.S. entities, pension funds, corporations, and wealthy individuals who hold their money offshore in U.S. treasuries. They hold them in U.S. treasuries so they don't have a currency risk. It's denominated in dollars. And they hold it offshore because there are tax advantages to having those assets and earning that interest offshore. But there's an untold amount of this $8.7 trillion that is actually held by Americans overseas, corporations, institutional investors, and individuals. Let's talk about gold. Gold prices continue to be volatile. They have been moving, right now gold prices are $3,338 for the June COMEX contract. That's up $32. It was down probably about $70 yesterday. It has been very volatile, but it continues to be in an upward trajectory. All of those economic and political issues that I've been talking about in this presentation relate to that. It's probably going to continue to be that way. We may see the gold price trade in a volatile fashion sideways for a while between, say, we were below $3,000 in March. So I'm not sure what the base could be. It could be $3,000. That's actually what CPM Group is telling its paying clients right now. And the high could be $3,600 for several months. But we do see an upward trajectory beyond that, because the economic and political problems that cause investors to buy more gold continue to be there. Central banks, by the way, continue to buy less gold. I think through the first quarter of this year, net central bank purchases were about 800,000 ounces of gold, We published our precious metals advisory for May yesterday, last night, and that number and a breakdown as to which central banks were buying and which central banks were selling is in the precious metals advisory for May. But you're seeing central banks saying, hey, I was an active buyer a year ago when the price was 2,000, 2,100, 3,300. Maybe I'm not buying so much. Or I'll buy the same dollar value, but it's going to buy a lot fewer ounces of gold at these levels. In fact, that's not exactly the case. They have pulled back the number of dollars they're spending on their gold, as well as the volume of gold that they're buying. But central banks aside, investors continue to buy gold. We saw a sharp increase in investment demand for gold through the ETFs during April. That's because central investors who don't have bullion trading accounts or futures trading accounts, they can buy gold ETFs if they have an equity account. So gold ETFs are the easy, quick way for generalist investors who don't necessarily invest in gold regularly to jump into the gold market and to jump out when they want to take profits. Silver prices have lagged gold. They're probably going to continue to lag gold because more investors in more parts of the world want gold rather than silver. We do see silver prices as moving sideways, similarly to the way we see gold over the next several months. We do see higher silver prices 12 months from now. But in the interim, we could see prices move sideways in a very volatile fashion. What's the base? Well, prices fell down to $27.56 in early April as a way to show you how fast silver prices can decline in 3 days. Silver prices can rise that fast in 3 days too. They haven't for a while, but they can. So we see silver trading in a very volatile fashion, sideways for the next few months, higher prices later on. And platinum and palladium, we continue to see suffering from a reduction in platinum and palladium demand in the auto industry, which is facing a host of problems, including the headwinds created by tariffs on parts and vehicles, as well as long-term secular shifts toward electric vehicles and toward fewer purchases of automobiles in the industrialized economy. So platinum and palladium, we see them continuing to move sideways. Platinum has been moving sideways since 2015. We don't see it breaking out of that range in the near term. And palladium has been moving sideways since really 2024. And it was spiked higher by a variety of factors in the early part of this decade, spiked to its peak when Russia invaded Ukraine. We'll be releasing our Silver Yearbook on the 27th of May. You can pre-order the book on our website, and you can also probably sign up to plug into the YouTube-based, or it's not YouTube-based, it's go to a webinar, but it's an internet-based briefing that we will be having on our analysis and outlook for silver at that time. And there will be a question and answer period where we can talk about it. We'll be speaking to the Society of Mining Engineers New York chapter, which is having its annual Current Trends in Mine Finance. We'll be speaking a couple times on the 20th and 21st of May. We'll be talking to Murdoch Capital Partners. They're having a Precious Metals and Critical Materials Conference on the 22nd here in New York, and the Astrologers Fund on June 11th. You can go to our website. You can pre-order the Silver Book. You can order and download the Gold Yearbook, which is already out. You can pre-order the Platinum Yearbook. You can buy and subscribe to the Precious Metals Advisory and get that information on central banks, as well as the information on the ETFs that are buying physical gold, as well as inventory information for London and New York and Shanghai in various markets. And you can send us a note at info@cpmgroup.com asking us how we can help you. Sorry I went on long. I hope this was useful and informative as to why we have a central bank and what the central bank can do and can't do, and what happens when you don't have a central bank. Take care of yourself. take care of others around you, take care of everybody, and try to do something good for the world. We're all in it together. Take care.